Warren Buffett's last warning: the ownership of the world's future wealth will shift. Greetings from FortuneCraft, ladies and gentlemen. If someone could effortlessly take your money and pocket it, would you call them a thief or a robber? But what if they could do so without angering you? Better yet, what if you admired them and even thanked them willingly? Most would bestow upon them the title Sage of Omaha. You'll soon realize that this Sage of Omaha, Warren Buffett, is no longer merely holding stocks. He's wielding a sniper rifle. In his recent letter to shareholders, his words read like a will or the final message of a seasoned warrior, signaling what may be the last chapter of his life. His sights are already set on his next target: what's coming. Lately, more and more people have vanished from the stock market. Buffett notes that from the third quarter of 2023 to 2024, the U.S. stock market surged by 30%, while his returns lagged at just 9%. Many investors have outperformed him, and some mock him as an outdated contrarian, an old man out of touch. I'm laughing too, but for a different reason. Buffett has twice outperformed the market in his career. The first time was in 2000, just before the dot-com bubble burst. The second was in 2007, ahead of the financial crisis. What does this suggest? Imagine you have $100 and invest it all for a 10% profit. You'd earn $10, but if you only invest $10 of that $100 and still make 10%, your profit is just $1, or 1% of your total capital. Buffett beat the market by selling stocks like Apple and Bank of America at their peaks while the market kept climbing. Now, he's sitting on over $300 billion in cash. He's cashed out. It's as if he's holding the most powerful sniper rifle in history. What does this imply? In 2002, companies under Buffett's control downgraded the credit ratings of junk bonds. The market panicked, dumping the bonds and crashing their prices. Buffett quietly bought them up. By 2003, after amassing enough, his company abruptly raised the ratings, sending bond prices soaring. He sold at a hefty profit. That was just the start. When banks caught on, they began bundling real estate loans into subprime bonds and flooding the market. Investors worldwide piled in, inflating the bubble. Meanwhile, Buffett pulled back, hoarding cash. By 2007, his company downgraded ratings again, triggering a market collapse. Lehman Brothers went bankrupt, and the global middle class panicked, selling off stocks and real estate as their wealth evaporated. Buffett, ever the patriot, swooped in, buying up discounted assets. Soon after, when the Federal Reserve unleashed unlimited money into the markets, his investments ballooned in value during the 2008 crisis. This tale is no Wall Street secret. Buffett's company was fined for manipulating credit ratings, and he had sold most of his stocks before 2007, holding cash to reap massive gains during the meltdown. Piecing these events together, it might seem like part of a grand design. This time, Buffett isn't alone in targeting prey. Bill Gates, Jeff Bezos, Mark Zuckerberg, and Jensen Huang have all sold their companies' stocks at peak prices. They're the hunters. Where do you stand? Will you be a hunter or the hunted? It hinges on your perspective today. This discussion aims to widen your view, encouraging you to track these titans' moves closely. Greetings again from FortuneCraft. Ladies and gentlemen, retail investors and the ultra-wealthy are inherently at odds. Do you agree? If Buffett amassed his fortune in the stock market, doesn't that mean others lost theirs? His gains often imply someone else's losses. You might even resent his wealth, yet why would you thank him? Some might find my words offensive, thinking I'm attacking Buffett. That's not my aim. Buffett has taught me plenty, just perhaps not the lessons most take away. Consider this. Suppose I want to sell 12 and 20 houses and hire 100 construction workers. If my wages only enable the workers to buy 100 houses, the remaining 20 represent my profit. 20%, but if those 20 houses don't sell, I earn nothing. To guarantee sales and profit, I'd lend the workers money to buy those extra 20 houses. Now I'd make not just a 20% profit, but also interest on the loans. But what if no one wants those houses? I'd raise the price to $1 million. If they still don't sell, I'd push it to $10 million, then $100 million. At $100 million, buyers emerge. The cycle persists. I profit more, while workers drown in debt. Yet you'd still thank me for lending you money to buy a home, and for giving you a job, right? Beyond Sage of Omaha. What else is Buffett called? A long-term investor. A value investor, correct? He promotes the idea that idle money loses value over time. No need to worry, just invest in U.S. stocks, seek undervalued gems, and hold them long-term. Follow his lead, and you could become a billionaire, right? But why do the stock market's losers tend to be these very followers? Ever wonder what happens if no one invests in stocks? Who would Buffett profit from then? Likewise, if I build a house and no one buys it, who will? As long as people work, earn, and pour money into stocks, the market becomes a cash machine for the rich to tap endlessly. It's all connected. You work and earn money. If you don't invest it, inflation, fueled by the Federal Reserve cutting rates or expanding its balance sheet, erodes its value. You're nudged into stocks, and the U.S. market, home to the world's top companies, beckons. To play there, you study Buffett. And when does Buffett make his biggest gains? During financial crises. Is this a rigged game? Why doesn't Buffett push gold? Some say it's because gold pays no dividends, isn't profitable, or grows too slowly for him. Yet he's bought plenty of gold and silver in the past. What's the difference? In 2006, Buffett owned 25% of the world's silver supply. A staggering feat. Even in stocks like Coca-Cola, his stake is under 10%. Since 1971, gold's price has soared 77-fold, while silver's has risen just 15-fold. Does Buffett truly favor silver over gold? If he hoarded gold, it could signal dollar devaluation. Gold often moves inversely to the dollar. If dollars lost 5% of their value, would you say, in Japan, still invest in U.S. stocks? You'd lose 5% up front, converting yen to dollars, regardless of stock performance. Bonds face similar risks as nations hoard gold over debt. Bond prices drop, yields rise, and buyers dwindle. Gold's price resists manipulation because others buy when it dips. Silver, an industrial metal not held as a reserve, is easier to control and doesn't threaten the dollar. The dollar's dominance lets the U.S. print money freely to buy global assets, the foundation of this strategy. If stocks stagnate, money gets pumped in, prices rise, and buyers rush in. Creating an idol, like Buffett, unifies belief, much like Confucius, or historical figures shaped thought. Trust reduces crime. Rulers know unified ideas outstrip laws. Visit Japan. Its driver's discipline humbles me. Despite similar rules, controlled minds shape behavior, paving the way for concepts like long-term investing. Buffett holds stocks for about a year on average, yet you hold without stop losses, refusing to sell. Aren't you prime prey? He touts value investing. Buy undervalued stocks. You see a dip, buy, and get trapped. But Buffett buys direct from insiders at discounts, not the open market. If you offered him stock 30% below market price, he might pass. He's already profitable from his entry point and can hold indefinitely. You can't. He leverages insider knowledge, not public news. Applying his methods as a retail investor is like a child in oversized clothes. You don't need to dissect financials. The goal is to steer global wealth into dollars, then US stocks, trigger a crisis, and harvest assets cheaply. Buffett's cash hoard has hit record highs 5 times. In 1969, as markets boomed, he nearly dissolved his partnership. A year later, stocks fell 35%. He bought low. In 1987, he sold most holdings. 2 months later, the market crashed 36%. In 1999, he avoided tech stocks. The bubble burst and they dropped 78%. Then came 2007. Now it's the 5th time. Regulators watch him as a signal for big players, not retail, to sell and hold cash. For small investors, it's a casino. Advice falls on deaf ears. 4 coincidences might be chance. 5. Why did he sell Bank of America? A golden goose. Debt is ballooning. AI fuels a stock bubble, and commercial real estate teeters. Vacant offices from remote work, dying malls, and lax theft laws cripple businesses. Stocks rise as people speculate rather than build. If tenants can't pay rent, landlords default, banks seize properties, and auctions tank values. Panic withdrawals could break banks. Echoes of 2008. Buffett sold to buy back later, as he did with Goldman Sachs, securing perpetual dividends. He'll scoop up assets post-crash, earning gratitude for saving the market. Our edge as small investors? Agility. Buffett plans sales months ahead. We can move millions instantly. Guerrilla tactics. Quick profits, fast exits, keep us liquid. Pick stocks systematically, not emotionally. This may be Buffett's final act. Next up, Elon Musk, the disruptor to Buffett's sage. Both icons sell the same dream. Faith in America pays. With currencies weakening and Trump looming, landmines await. If one sentence here aids your life, I'm content. Thank you from FortuneCraft. Goodbye.